Thank you for gathering here today. My name is Satoshi Kono, Executive Vice President of Raccoon Holdings, Inc. The summary of financial results for the period corresponding to the first quarter of the fiscal year ending April 2026 was released approximately half an hour ago, so allow me to walk you through some of the key details. After this, we will be taking questions from stakeholders during the Q&A session. We have identified a couple of key points that greatly impacted our results. As you know, Raccoon operates its super delivery platform in Japan and overseas, and we also offer our paid and Uriho services as the financial business. In a nutshell, while we did see some headwinds in terms of the international super delivery business, both the domestic EC business and both of our services, paid and Uriho, in the financial business had a steady start. Raccoon's international super delivery operations were significantly affected by U.S. tariff policies over the course of the first quarter. This translated into a slight decline in the GMV growth rate, but perhaps more impactful were shipping costs as a one-off factor. I will be going over the details in a moment, but just to give you the highlights, shipping costs increased by just over 30 million yen on a YOY basis in the first quarter. Profits were down in the first quarter, and a significant factor in this profit decline was higher shipping costs. Again, I will be going over the details in a moment, but as of August, shipping costs within our international EC business have shown significant improvement, so we view this as a temporary headwind. Let's delve deeper into the factors that define the results for the first quarter. Over this 3-month period, we recorded 1.559 billion yen in net sales, corresponding to a YOY increase of 2.3%. It should, however, be noted that we sold our rent guarantee business, which was operated under the purview of our wholly owned subsidiary of Raccoon Rent and within the broader financial business, at the beginning of the third quarter last year. The divestiture of the rent guarantee business complicates YOY comparables for the first quarter, so a more accurate comparison would be to look at consolidated net sales excluding the impact of the rent guarantee business. As you can see, controlling for this variable reveals a YOY growth in net sales of 9.7% for the period under review, just shy of double digits. Looking at the financial business in isolation, we posted a very strong performance, growing sales by 14.5% on a YOY basis. In the EC business, international GMV declined due to the impact of US tariffs, but domestic performance was relatively strong, supported by the bottoming out of the metric of average sales per customer. All in all, net sales grew by 6.6% YOY in the EC business. I will cover the details in a moment, but this bottoming out of the metric of average sales per customer in Japan is a significant victory for us and very beneficial. We recorded 271 million yen in operating income, which corresponds to a YOY decrease of 9.6%. Our operations in the international EC business were negatively affected by US tariffs, with overseas shipping costs increasing by 31 million yen YOY in the period under review. While there is a time lag before we start seeing results, we do expect a gradual decrease in the impact going forward. Additionally, if you'll remember, the revision of reinsurance terms in the financial business had a profound impact on fourth quarter results last fiscal year, since reinsurance costs are part of the cost of sales. This added approximately 40 million yen to the cost of sales on a one-off basis in the fourth quarter, but the impact was fairly minuscule in terms of first quarter results, allowing us to keep the rate of cost of sales at an appropriate level. In short, I would like to assuage any concerns stakeholders might have on this front. Let us now take a more detailed look at the income statement. We recorded 1.559 billion yen in net sales and 1.272 billion yen in gross profit, up 4.3% on a YOY basis, and 271 million yen in operating income. The income statement expands on our earlier discussion with a detailed breakdown of each line item. We encourage you to review the figures at your convenience. This next section contains the results excluding the impact of advertising and sales promotion expenses. Advertising and sales promotion expenses totaled 243 million yen in the first quarter of last year and increased by just over 10 million yen on a YOY basis to 256 million yen. According to the breakdown, advertising and sales promotion expenses were more or less flat in the financial business, showing a modest increase from 57 to 58 million yen. In the EC business, these expenses went from 185 million to 198 million yen, which corresponds to a YOY increase of 13 million yen. This strategy of deploying advertising resources to bring new members to our platform and grow GMV is foundational to our EC business. Some ad spend is inevitable, but our real ambition here is to achieve a flywheel effect that obviates the need for us to expend advertising resources in proportion to this increase in our user base. I will be going over this strategy in more detail in a moment. The vertical bar graph on the left shows group GMV over time. We position KPIs within this metric of group GMV, such as super delivery GMV from our EC business and the transaction volume for paid. There are some cases where customers use paid for purchases within super delivery, so we adjust for this to avoid double counting and call this overall metric group GMV, which delivered double-digit growth of 10.7%. We also have Uriho's guarantee balance on the right, which continues showing very strong growth as well. Uriho's guarantee balance stood at 65 billion yen as of the end of the first quarter, having grown 14.9% on a YOY basis. Next is the trend in consolidated net sales. As we discussed earlier, the inclusion of the legacy rent guarantee business in first quarter results made for a challenging YOY comparison. That said, excluding this results artifact, net sales actually grew by 9.7% on a YOY basis, underscoring a strong sales performance. You can see the breakdown by business on the right. Sales grew by 6.6% in the EC business and decreased by 3.2% in the financial business, on account of the divestment of the rent guarantee business. Excluding the impact of the transfer of the rent guarantee business, sales in the financial business grew at a rather fast clip of 14.5%. Sales in the EC business were down 0.1% on a QOQ basis and up 6.6% on a YOY basis. Seasonally, the first quarter is a slow period for growth in our EC business, as is the second quarter, and then we make up for it with a strong sales performance in the third and fourth quarters. We're talking about a QOQ decrease of 0.1%, or approximately 1 million yen, so for all intents and purposes, this performance was in line with the fourth quarter baseline. In other words, this was a strong first quarter showing from the EC business, especially when taking into account the headwinds we faced in our international operations. This dynamic really underscores the strength of our results in domestic EC. Net sales in the financial business increased by 3.4% on a QOQ basis. It should be noted that we had already divested the rent guarantee business by the fourth quarter, so this QOQ growth of 3.4% is an apples-to-apples comparison. The aforementioned results artifact caused by the transfer of the rent guarantee business created a YOY decrease. Quarterly gross profit for the first quarter was 1.272 billion yen, 731 million yen in the EC business, and 535 million yen in the financial business. Gross profit is positively correlated with sales, so the direction and magnitude of the figures are also similar. Gross profit in the financial business went from 496 million yen in the fourth quarter to 535 million yen in the first quarter of the ongoing fiscal year. This represents a significant QOQ growth of 7.9%. That said, as I touched upon earlier, we had the revision of reinsurance terms in the fourth quarter, which raised the cost of sales. This, in turn, made for a slightly easier results comparable in terms of gross profit in the financial business. Next are the trends in expense composition, namely as it pertains to selling, general, and administrative expenses. We divide these into three broad categories, namely advertising and sales promotion, personnel, and other expenses. Circling back to what I said at the beginning, advertising expenses increased slightly from 243 million to 256 million yen. Personnel expenses went from 471 million to 497 million yen on account of things like the hiring of new graduates and cost of living adjustments to employee salaries. Personnel expenses were therefore up somewhat. That said, our stance on salary hikes to reflect inflation has remained constant over the years, and we have strategically implemented policies reflecting this over time. This pre-planned and strategic increase to the salary baseline was completed in the first half, so we expect the rate of increase itself in personnel expenses to gradually decline over time. As I mentioned earlier, another factor was an increase of 31 million yen in overseas shipping costs, which is included here in the category of other, and which accounts for a large chunk of the overall increase in selling, general, and administrative expenses. That said, we expect the category of other expenses to come down in the second quarter, as the negative impact of higher overseas shipping costs should gradually moderate over time. In short, while it wouldn't be accurate to say the 247 million yen in other expenses is a complete one-off phenomenon, we do expect this increase to be contained to first quarter results. Next is operating income, which was greatly impacted by the US tariffs. In fact, the tariffs were a significant reason for the lower operating income results in the first quarter versus a fiscal year ended April 2025 baseline. As you may be aware, we started offering a free-of-charge plan and deployed considerable advertising resources, and this ultimately led to a YOY operating income decline in the fiscal year ended April 2024. We only started these measures later in the fiscal year, so fiscal year 2024 first quarter results weren't affected by this. Next are the trends in operating income by quarter. As you can see from the graph, and as I mentioned earlier, first quarter operating income results were normal, but then dipped considerably in the second, third, and fourth quarters as a result of the deployment of massive advertising expenses. This slump lasted 3 quarters over the course of the fiscal year ended April 2024, and in the first quarter of the fiscal year ending April 2026, it was higher overseas shipping costs that weighed down on results. Allow me to proceed to the summary by segment. First is the EC business. We delivered 922 million yen in segment net sales in the EC business, corresponding to a YOY increase of 6.6%. Conversely, segment profit decreased by 3.8% YOY, or 287 million yen. In terms of the KPIs, we recorded 7.267 billion yen in gross merchandise value, corresponding to a YOY increase of 8.5%. The full-year target for GMV is 10.8%, so we fell slightly short of this threshold in the first quarter. Domestic GMV stood at 5.293 billion yen, corresponding to a YOY growth of 9.9%. We are guiding for a YOY growth of 9.4% in domestic GMV in the fiscal year ending April 2026, so current results slightly exceed our expectations. On the other hand, international GMV didn't have a good showing in the first quarter. Specifically, we recorded 1.974 billion yen in international GMV, corresponding to a YOY growth of 4.9%. Since we are guiding for a YOY growth of 14.5% in this category, this is a significant underperformance versus the full fiscal year target. The waterfall chart on the right details the factors affecting changes in segment profit. We boast very high profit margins, so the cost of sales hardly moved alongside the increase in net sales. The increase in advertising and personnel expenses wasn't actually all that large, with the increase in overseas shipping costs being the single most significant factor that weighed on operating income results in the first quarter. In short, I believe this waterfall chart neatly describes the segment profit dynamics for Raccoon's EC business. Within domestic EC, we recorded 5.293 billion yen in GMV, corresponding to a YOY growth of 9.9%. The number of buying customers was 32,225 stores, up 11.3% on a YOY basis, and representing double-digit growth. Conversely, average sales per buying customer was 164,252 yen, down slightly over the same period, 1.3% to be precise. A decline in the metric of average sales per buying customer starting in the fiscal year ended April 2024 has greatly negatively impacted domestic GMV results. That said, as you can see from the table on the bottom right hand of the page, the rate of this decline has slowed down considerably over time. Case in point, average sales per buying customer was down 15.5% in the first quarter of fiscal year 2025, and then 8.7% in the second quarter, but this metric has since improved. Based on this, we think it is now safe to surmise that a decrease in average sales per buying customer isn't likely to have a significant negative impact on GMV going forward. In light of this, and considering how the number of buying customers increased by 11.3% on a YOY basis, we believe it's safe to say that, so long as the number of buying customers keeps increasing, this will continue to translate into GMV growth. We are therefore confident that the decrease in average sales per buying customer has now bottomed out. Earlier, I mentioned a positive correlation between advertising spend and GMV. This relationship continues to hold true, but a key area we are focusing our efforts on is fostering organic traffic. We've always incorporated this into our strategies and operations, of course, but we are redoubling our efforts to bring in more organic traffic, including through things like our SEO strategy. The rationale behind this is that we want to decouple, at least to some extent, net sales, GMV, and the number of companies we do business with from the metric of advertising expenses. In other words, one reason behind this strategy is that we want to slow the pace of growth in our advertising spend. This isn't all, as there is a non-trivial difference in the LTV between customers acquired organically and those acquired through paid advertising. In fact, the LTV is approximately 3 times higher for customers acquired organically. This class of customer uses our platform more frequently, has a higher average sales per buying customer metric, and is more likely to become a repeat customer. To reiterate, customers acquired organically have a much higher LTV than those acquired through paid advertising, which is why we are dedicating considerable efforts to enhancing our organic funnel. We launched an AI recommendation function in June, with the expectation that this will lead to future increases in both the number of buying customers and average sales per buying customer. As you are aware, recommendation functions and algorithms are a common feature in B2C sites, and the idea here is to leverage AI to offer better matching accuracy. This is a recent initiative that has yet to yield any major benefits, but we expect that this AI will only get more accurate as we accumulate more data over time. Ultimately, we expect this feature to act as a tailwind for us in terms of the number of buying customers and average sales per buying customer. Next is the international EC segment, which posted somewhat lackluster results. The table shows the GMV growth rate for our 4 core markets. Taiwan delivered a YOY GMV growth of 3.2%, as this market continues experiencing a recovery. Now, I know 3.2% doesn't sound like much, but this actually highlights a recovery after a period of YOY contractions, as this market posts better or worse results while remaining in positive growth territory. Against this backdrop, we view the fact that this market remains firmly in positive growth territory as a victory. Next is Hong Kong, which posted an abysmal GMV growth performance of negative 23.1%. This decline was one of the reasons for our underperformance in the segment of international EC. As I've discussed on previous occasions, Hong Kong is struggling economically, to such an extent that we have nearly completely ceased all advertising promotions in the region, since these efforts simply failed to meet our return on investment criteria. Instead, we allocate this advertising budget to the other markets. So, in the absence of proactive advertising, we expect this market to continue seeing an erosion in terms of GMV. While we haven't given up on this market, we have no short-term plans to increase our advertising budget for Hong Kong. The GMV growth rate for the US was 11.7%. This is strong double-digit growth, but since we were aiming a bit higher, realized results ultimately failed to live up to our expectations. Lastly, South Korea delivered a robust GMV growth rate of 12.2%. Allow me to direct your attention to the metric of buying customers and value of transactions per customer. Noteworthy here is a very slight decrease, if you can even call it that, in the number of buying customers, precipitated primarily by the impact of the US tariffs. We believe a decline in the US market was the reason for this slight overall decline. I really emphasized the impact of the tariffs in the context of higher shipping costs. The impacts on our business are extensive. An example is the so-called de minimis threshold, which allows goods under $800 to be imported into the US, duty and tax-free. This law had long been in place, but starting this May, the US government changed the rule and now tariffs products made in China and Hong Kong, even products under the $800 threshold. Then, either toward the end of August or early in September, the current administration now seeks to expand the scope of the tariffs to cover products even under $800 and from all countries and regions, not just China or Hong Kong. The introduction of the tariffs naturally led to a decrease in the number of buying customers in the US, and this was the most significant factor for this overall decrease. Even though the added costs are obviously a negative, this is more than just a monetary issue, because tariffs make the process of importing these products more onerous through forms and customs procedures. In light of this, some customers have been reluctant to buy products that require the payment of tariffs. Another issue is shipping costs. Now, this is quite a complex topic, but in a nutshell, we used a specific logistics partner for our US shipping that is very good with shipments valued under the $800 threshold. With the removal of the de minimis exemption, this business relationship ended, and we have shifted these shipments to a different company. A consequence of this is a less favorable cost structure, as we haven't been able to completely fine-tune our processes to offset the change. We're moving as quickly as possible to make the necessary adjustments, and while what will happen in September and October remains to be seen, at the very least we can say that we've seen good improvements for the month of August. In short, we're making good progress and seeing good results in our fine-tuning efforts. The trends in super delivery gross merchandise value are as shown here. In essence, this is merely a visual representation of the dynamics I just described, so we invite you to go over the figures at your convenience. Let's now take a look at the trends in the number of buying customers and the value of transactions per customer. Specifically, this vertical bar graph shows the trend in the number of buying customers. The shorter textured bar represents the number of first-time purchasers, which remained at levels in line with fourth quarter results. We also saw an improvement in repeat purchasers, exceeding the speed of increase between the third and fourth quarters as well. Again, the impact of the new tariff regime in the US weighed on results and makes this increase in repeat purchasers appear small. But since we continue to see robust growth in the domestic market in Japan, we don't see any particular cause for concern on this front. The trend in the value of transactions per customer is as described in the line graph on page 21. The trend is now mostly flat without any sharp declines like in the past, especially for domestic retailers. Conversely, we are seeing a very robust trend in the international market, with a growing trend in the value of transactions per customer. The trend in sales is as shown here as well. System usage accounts for the largest proportion of overall sales and is proportional to GMV, so it naturally follows the same curve over time. Here are the trends in operating profit. In particular, This slide deals with the impact of increased shipping costs, which weighed significantly on first quarter results. This concludes our overview of the results in the EC business. Allow me to proceed to the results in the financial business. We recorded 636 million yen in segment net sales, corresponding to a YOY decrease of 3.2%, and 181 million yen in segment profit, down 1% on a YOY basis, which is to say, basically flat. As I said, segment net sales were down 3.2%, but as I am sure you've surmised by now, this is primarily a results artifact from the sale of the rent guarantee business. Looking at each business in isolation, Paid delivered a YOY net sales growth of 17%, while Uriho grew net sales by 12.8%. As you can see, we delivered a rather robust performance from both the Paid and Uriho businesses. Looking at the KPIs, Paid transaction volume totaled 10.975 billion yen and was up 12.2% on a YOY basis. Similarly, Uriho's guarantee balance stood at 65.911 billion yen, corresponding to a YOY growth of 14.9%. While realized results came in slightly below full-year targets for these KPIs, the financial business is characterized by steady, gradual growth, so we believe there is more than enough room for a recovery in the second half of the fiscal year. Segment profit was mostly unchanged on a YOY basis. Allow me to give you some color as to why. The reason is actually quite simple and stems from the decrease in gross profit after the sale of the rent guarantee business. As you can see from the waterfall chart, the sale of the rent guarantee business resulted in a decrease in gross profit of 60 million yen. In other words, this corresponds to the gross profit we derived from the rent guarantee business in the first quarter last fiscal year, and which we didn't record this year. Conversely, Paid and Uriho continue growing, as does the gross profit from these businesses. Gross profit from these businesses was 49 million yen, which wasn't enough to offset the 60 million yen reduction from the sale of the rent guarantee business, so ultimately, segment profit was pretty much a wash and came in at levels essentially equivalent to last fiscal year. We were able to reduce personnel expenses slightly, and ultimately, segment profit went from 183 million yen in the first quarter of the fiscal year ended April 2025 to 181 million yen in the same period the following year. Next is the trend in transaction volume for Paid, which we position as this business's KPI. As you can see from the vertical bar graph, external transactions totaled 10.975 billion yen and grew by 12.2% on a YOY basis in the first quarter. Uriho's guarantee balance stood at 65.911 billion yen as of the end of the first quarter. You'll notice an accelerating trend starting in the third quarter, underscoring very strong growth. Next is the graph with the trends in sales. I've mentioned the sale of the rent guarantee business throughout this presentation, and the graph on page 28 contains an easily digestible visual representation of the decrease in sales resulting from the divestment of this business. As you can see, the light-colored section is absent starting in the third quarter. Despite this, the two remaining businesses have delivered very strong growth, and this growth is evident from the graph. Since the divestment took place in the third quarter of last fiscal year, this apparent slump will continue until the second quarter next year. Next are the trends in the cost of sales, which essentially corresponds to the rate of defaults in this business. The cost of sales rose significantly in the fourth quarter, as we had to record a temporary cost associated with the revision of reinsurance terms. Naturally, this impact has now dissipated, and default rates are now trending at nearly ideal levels. Against a rather steep surge in corporate bankruptcies, this tends to be an area of interest and concern to investors, but as you can see, we have been able to keep default rates under control through appropriate credit screenings. Ultimately, we have been able to sustain a gross profit margin of around 75%, and this puts us in a good position. Last are the trends in segment profit in the financial business. While the impact of the revision of insurance terms in the fourth quarter last year led to a precipitous drop in segment profit, This metric has since staged a recovery. Additionally, as we went over earlier, the sale of the rent guarantee business impacted profits, but excluding these impacts, we have great efficiency in terms of system development and personnel resources. Regarding resources pertaining to R&D in particular, we have been able to focus on growth domains like e-commerce and paid and Uriho. We position these as future growth drivers, so we view these as having potential for a good return on investment. This concludes my presentation. Thank you for your time.